And let me now bring on board Amit Bhartia, portfolio manager with GMO. GMO is one of the biggest money managers in emerging markets. Amit, fantastic to have you back on ET Now. Thank you for joining us. Amit, do you think for emerging markets now, adjustment to a world where Fed liquidity will be less will be a big painful process?
Well, this has been a long time coming. I mean, the precedent was already set up last year, so the markets pretty much knew this is going to happen. And as I've been saying, the U.S. economy is actually surprising on the upside. So, I mean, in my opinion, the risk to the markets is that, going forward, the taper is much more than market participants think. So that's the risk. But, this is pretty much well known, and I'm actually a bit surprised why markets are reacting so negatively to this.
What about India? Because we in any case have been in a little bit of a tentative position, working with dynamics of rate hike, upcoming elections, etc.
Well, actually, India took a fair amount of pain last year, and so you can see that actually India is actually doing much better than, the so-called fragile five, even though I don't believe the concept. But if you look at countries like Turkey and South Africa, which really didn't take the pain that much last year. So if you look at both India and Indonesia, in some sense, they are doing much better. The volatility in the currency markets are also not that severe compared to some of the other markets. So it's, but I think what will drive India is more of politics, what kind of government comes to power, what are their policies. And I think that's the biggest driver to India, not this rate hike.
Amit, so on every big decline, will you be a buyer in Indian equities? Because of late my understanding is that GMO as a house is not that negative on India.
Yeah, again, as I said, Nikunj, I mean, a lot depends upon politics. If you have a stable government with a commitment to growth and a clear visibility from our side that, growth kind of accelerates, jobs get created, consumption in some sense comes back into the economy, then, definitely will increase our allocation. So it's pretty much data dependent, in my opinion.
Only increase your allocation to Indian equities after the outcome of general elections. Before that, you are likely to remain neutral irrespective of valuations, irrespective of news flow. Is that what you're indicating?
Kind of, I mean, one of the things I've always said, Nikunj, is valuation is actually a second derivative. I mean, if you have good macro policies, growth comes back, then earnings come and, stocks become actually cheaper. So that's the driver. But, I mean, within India, if you see there is a fair amount of divergence, you have an export-oriented sector which, has done much better, and primarily it is because of concerns about the domestic economy. So, the way index will move, I think it's all dependent on, how what happens in the domestic economy.
Amit, the BSE bulk deal data is indicating that you're buying some cyclical stocks in India. Why are you bullish on Indian cyclical stocks?
Well, as a policy, I can't really comment on individual names, but, some of the cyclicals have been cheap, so, we've bought it. But, but it could very well be a tactical trading strategy.
What would you do with export-oriented spaces, the likes of pharma and IT? Would you stay put in those names?
Well, they definitely deserve a place in, in a portfolio in an Indian context where, if the macro backdrop remains shaky, then obviously you need certain hedges in the portfolio. So if you have a situation where, there is no stable government, currencies are weak, then obviously, the software sector and export-oriented sector does much better. So it's very difficult to predict the outcome as of now. But again, from a portfolio context, you need, a fair amount of balance within the portfolio. You really can't say, look, I'm going fully, I'll be fully invested in export-oriented sector, but not domestic cyclicals and so on. So it's actually how much risk you want to take in the portfolio.
Amit, final question. Historically, we've seen that emerging markets, they always tend to hunt together, they tend to move together. But is there a case that once the dust settles down, India clearly will outperform other emerging markets like it has done in last 3 months?
It is possible. I mean, if you look at last year, I mean, except if you look at history within emerging markets, only if you have like a full-blown contagion in which all the markets pretty much are clubbed together. But historically, if you see the difference between the top and the bottom quartile, of countries, is as high as, 50-60%, basically. So it all depends. I mean, a good example is Indonesia this year. I mean, this has been, a worst performing market last 2 years. But again, this year, Indonesian market is up 2-3%, whereas the average emerging market is down 7% because, investors kind of realize, okay, current account is likely to come down. Politics is more stable in Indonesia likely this year. So it's again a function of that. So if markets perceive, look, there is stable politics in India and economy kind of re-accelerates back, then India could very well be, ahead of the pack.